Good morning, welcome and thank you for participating in this morning's workshop. And to date, we are pleased to advise that we have close to 600 participants on the webcast for this workshop. Now, ABS has been working closely with the steering committee for SOR transition to SORA, the SC-STS, and the various technical subgroups. The purpose of this workshop is for us to share with your institution more details of the strategy, roadmap, and key issues of the proposed transition from SOR to SORA, as well as the impact this will have on your business. There will be major implications to your institution, such as the need for customer education on new SORA products, transition of legacy contracts and accounting treatment changes, and these will require your institution to plan and budget in advance for necessary system upgrades. Now, this is a program for today's workshop. For the purpose of today's workshop, you will only view the slides as the presenters make their delivery. So you can't see all of us here in this room in ABS. Now, we will commence with an overview by MAS, followed by presentations of the various subgroup topics, and ending with a panel of the subgroup reps and MAS to address the questions which you could submit through the Pigeonhole portal throughout the presentations. We will address the questions submitted through Pigeonhole only. So please note the Pigeonhole address and password to launch the portal. You may also look out for the orange Pigeonhole icon at the bottom left-hand corner of your screen to trigger the portal, and this will be screened throughout the presentation. And now it's my pleasure to introduce Mr. Leong Sing Cheong, Assistant Managing Director for Markets Investment of MAS, to deliver the presentation on SOR to SORA, key focus areas and milestones ahead. Ladies and gentlemen, Sing Cheong.
Thank you very much, Aibun. First, let me thank ABS for organizing this workshop. Very grateful for the opportunity to speak to industry players on this issue that has important implications for the Sing dollar financial markets. So, as many of you will know by now, the likely discontinuation of LIBOR by end 2021 will also spell the end of SOR. This has significant implications because SOR underpins key elements of the Sing dollar financial markets. Our entire 3.5 trillion Sing dollar derivatives market is pegged to SOR. SOR is also widely used in Sing dollar cash market products such as business loans, syndicated loans, retail mortgages, and floating rate notes. So today, allow me to share some thoughts on the following as reflected in the slides. First, is this really the end of LIBOR? Second, why SORA? Third, what are the key focus areas that the steering committee on transition from SOR to SORA is focusing on? And last, what should you be doing to prepare yourselves for this transition? I'll very likely overshoot my allocated time, but I thought it's important to get into details of these specific areas to bring everybody on the same page. So, is this really the end of LIBOR? I think first, it's worth recapping why global authorities are pushing this. In July 2014, the Financial Stability Board published a report on reforming major interest rate benchmarks. Key recommendation of the report was for relevant authorities and market participants to identify and develop near risk-free rates, or RFRs, and to encourage derivative market participants to transition to such RFRs. In response, several major jurisdictions globally have identified RFRs for use in their respective currency areas. These include the US dollar SOFR and the sterling SONIA. Since July 2017, the UK authorities have stated in clear and unambiguous terms that LIBOR will end. In particular, the UK FCA, the Financial Conduct Authority, has also sketched out two possibilities for the end game for LIBOR. First, for all LIBOR currency tenors, a final cessation date or end date can be announced in advance by the benchmark administrator or the regulator. Another variant of the endgame is LIBOR's loss of representativeness. This means that even before LIBOR's final cessation date, it could be preceded by a period where it is no longer assessed by the UK FCA to be representative under the EU benchmarks regulation. This can arise because of reduced panel bank submissions. UK FCA has further highlighted that any period of non-representative LIBOR would not last for more than a short period, i.e. a period of months, not years. Now, in the meantime, the UK FCA and BOE, Bank of England, have endorsed clear and specific timelines on the transition roadmap for sterling LIBOR. Market makers are encouraged to switch the market convention for sterling interest rate swaps from LIBOR to SONIA on 2nd March 2020. This is literally in 2 weeks' time. Issuance of cash products linked to sterling LIBOR should cease by end Q3 2020, this year. In the US, while liquidity in SOFR swaps is still relatively thin, this is expected to change in the year ahead. On 5th Feb 2020, the Federal Housing Finance Agency announced that Fannie Mae and Freddie Mac will stop accepting variable rate mortgages based on LIBOR by end 2020, and that they will start accepting SOFR variable rate mortgages later in 2020. The London Clearing House and the Chicago Mercantile Exchange are also expected to switch US dollar swaps discounting from the effective Fed funds rate to SOFR in October 2020. This will result in a need to hedge SOFR risk and drive increased liquidity, as well as extend the tenors of SOFR swaps trading. So based on all the above indicators, it is clear that the train has left the station. LIBOR will end, and it's critically important for us to prepare our industry to transition to a new SORA benchmark in advance of the end of SOR by end 2021. So, why SORA? Indeed, why not choose SIBOR, which is an existing benchmark and which the market is familiar with? The ABS and the Singapore Foreign Exchange Markets Committee, the SFEMC, has studied this issue extensively and issued a public consultation report in August last year. I'll briefly outline why SORA was chosen and why SIBOR as a replacement for SOR was ruled out. First, SORA is underpinned by a deep and liquid overnight interbank funding market with a daily average of $2 billion of underlying transactions. SORA reflects the volume-weighted average rate of all Sing dollar overnight cash transactions brokered in Singapore during the business day. In comparison, the market underpinning SIBOR is only a fraction of SORA's underlying market, as post-crisis regulations have resulted in declining term unsecured funding markets. Second, as the Sing dollar derivatives market sees active participation from global institutions and investors, the ABS and SFEMC felt that it was important to align our market with international conventions and best practices to ensure that our Sing dollar interest rate market stays deep, liquid, and vibrant. So the use of SORA in Sing dollar derivatives market is in line with the global shift away from IBORs to referencing overnight RFRs. For market participants who are also active in international markets, this shift to SORA is aligned with overall measures to develop trading, operational, and risk management capabilities in other RFR-based derivatives. Third, the use of SORA can bring clear hedging benefits compared to SOR. The use of SOR had shortcomings previously when implied rates turned negative and the cash and derivatives markets tore as cash contracts floored the rates at zero, while derivatives contracts did not. So the shifting from SOR to SORA will avoid this issue, and SORA will be a more robust and reliable hedging tool. While SORA can be quite volatile on a daily basis as Singapore does not have an interest rate anchor, it was recognized that financial products with reference overnight rates, which reference overnight rates, typically use an average rate over a period and not a single day's rate. So in fact, compounded SORA rates are relatively more stable than SOR term rates, given the averaging effect. So in August last year, MAS set up an industry-led steering committee on the transition of SOR to SORA, which Ibun mentioned just now. The steering committee is led by Mr. Sam Sien, Group CEO of OCBC and ABS Chairman, and comprises senior representatives from MAS, key banks in Singapore, and relevant industry associations, including the Life Insurance Association, IMAS, the Association of Corporate Treasurers, and the SFEMC. The steering committee's overarching goal is to ensure continued market integrity and functionality in Sing dollar derivatives and money markets beyond end 2021. In achieving this, the steering committee also seeks to ensure that end customers are not left behind in this journey and that banks are equipped to help clients achieve a smooth and seamless transition as far as possible. But this is a complex task requiring close industry coordination in key areas. Getting SORA derivatives market up and running as soon as possible. The subgroup 1 on derivatives is working hard to get SORA OIS prices visible on screen to facilitate market making and trading by a wider community. So recently, some banks have started to do SORA test trades, and subgroup 1 aims to have active and liquid SORA derivatives trading by the middle of the year. With an active SORA derivatives market, we should be ready to engage cash market clients on what to do with their existing SOR exposures and what's the best route for transitioning out of SOR contracts. This requires a multi-pronged approach because we have to take care of different customer segments ranging from corporates to individuals. We need to deal with legacy exposures for SOR-based loan borrowings with a few more years to run, how to effectively shift towards SOR reference loan or bond borrowings for the remainder of the loan or bond duration. For new transactions, we need to help clients get familiar and comfortable with SORA-based products and encourage take-up. At some point, we will also need to decide when new SOR-based originations should cease. MAS is also studying the issuance of SORA floating rate notes, or FRNs, to provide a reference curve for issuers. Hopefully, this will also catalyze other issuers to explore issuing SORA FRNs. Now, one key feedback that the steering committee has been hearing from market participants is the request for a forward-looking term SORA benchmark. This issue is not unique to our market. In the US and the UK, they are similarly studying this issue and studying the construction of term RFRs. The steering committee will study how term SORA can be constructed later this year. But the viability of term SORA as a robust benchmark depends on the existence of a deep and liquid SORA OIS market. Our key banks will work hard to build liquidity in the underlying SORA OIS market, but this will take time. In the meantime, for the loan markets, it is important to recognize that the direction of travel in other major markets is towards the adoption of backward-looking compounded RFRs. Backward-looking compounded RFRs operate differently from today's forward-looking term rates, in that borrowers would lose a degree of payment certainty as they will only know the rate and hence their interest payments at the end rather than the start of the interest period. But backward-looking compounded rates can be widely adopted, particularly by the wholesale market, because first, such rates constructed from deep underlying overnight markets are very robust and not susceptible to manipulation. Second, given the averaging effect, backward-looking compounded RFRs are also more stable compared to forward-looking term rates, which are exposed to idiosyncratic market factors on a single day's fixing, such as quarter or year-end volatility. Third, since derivative markets are moving to compounded SORA, having loans pegged to compounded SORA allows for hedging in a more cost-effective and efficient manner, as basis risks between loan and derivative markets is avoided. Fourth, backward-looking SORA already exists. There is no need to wait. There are also other product structures based on backward-looking rates, which could still provide for payment certainty, for instance, by using SORA rates observed over an earlier period. Now, we acknowledge that any shift from forward-looking term rates to backward-looking compounded rates is quite a fundamental shift. However, the earlier we wrap our minds around this and think through what adjustments need to be undertaken to effect this shift, whether in terms of industry conventions, market practices, client education, or system changes, we can then get on with the various tasks that needs to be done and engage clients early. Conversely, waiting for term SORA to get up and running before FIs and clients make any moves could risk us getting stuck in a chicken and egg cycle, leaving far too little time between now and end 2021 to effect the transition from SOR to SORA, particularly as systems changes are required. So perhaps there's no better way to learn than to try it out. To this end, the Subgroup 1 and Subgroup 3 are collaborating to pilot suitable product structures, including structures based on compounded SORA. We intend to test these structures with corporates who could be early adopters and get their preliminary views. These could then serve as good use cases to engage the broader base of bank clients. If we are successful, we have an opportunity to shift to a more efficient and liquid Sing dollar cash and derivatives market. Another issue for the steering committee is how we can set up an appropriate safety net for legacy contracts. This is an important issue to ensure contract robustness and to mitigate the risks of contract frustration. The steering committee has undertaken a thorough review and assessed that adjusted SOR would be a more appropriate contractual fallback for SOR derivatives. Adjusted SOR is the fallback reference rate based on actual transactions in the dollar-Sing FX swap market, and adjusted SOFR, which is the US dollar LIBOR fallback in the updated 2006 ISDA definitions. Adjusted SOR is therefore more similar to and correlated with SOR. Accordingly, this will reduce value transfer risks. According to a May 2019 ISDA consultation, there was good support for the use of adjusted SOR as the fallback for SOR derivatives. Now, some of you may be wondering, why can't we just transition to adjusted SOR when SOR ceases? I think it's important to stress that banks should direct their primary efforts towards transitioning existing SOR-based transactions into the new benchmark. Nevertheless, to the extent that it may not be possible to achieve full transition by end 2021, having a fallback rate for a small number of residual legacy transactions helps to provide protection and certainty to both the bank and its client. But we certainly do not envisage that banks transition the bulk of their legacy book onto adjusted SOR. This is undesirable for the following reasons. First, adjusted SOR is not a benchmark rate and will not be liquid nor widely traded. Hence, risk management of adjusted SOR positions will not be cost efficient. In addition, adjusted SOR will have a limited shelf life. The steering committee will carefully consider what should be the appropriate length of the shelf life to provide some time buffer for legacy contracts to run off. But it is clear that there needs to be a specific end date to better support the overall move towards the new benchmark. Steering committee's view is that the most efficient transition is one where contracts that reference SOR are replaced or amended before fallback provisions are triggered. This should see a smaller legacy stock of such contracts in the period thereafter. This is what we should all work towards. So on key milestones ahead, here is how we envisage the SOR to SORA transition to occur, bearing in mind the current state of play in global and local markets. We have set out some indicative targets in this slide. In the first half of this year, expect to see steering committee's response to the consultation, to the feedback received on the consultation paper which we published last year. We should also see some developments on clearing of SORA derivatives, possible SORA FRN issuance. We are also looking to identify and engage early adopters in cash markets for SORA. And it is also important to develop client communication toolkits to aid banks' engagement with end clients. Second half of this year, we want to develop market guidance for transition of legacy SOR contracts, provide banks with market guidance on conventions, SORA conventions, templates, client communication toolkits. Banks should be able to engage their broader customer base more systematically. And we will also explore a recommended date to seize new originations for SOR derivatives and cash products. This is important because we don't want to add to legacy stocks. So by end 2020, we hope to see an active and liquid SORA derivatives market and to have made substantial progress in kickstarting SORA usage in cash markets. And then having front-loaded all the SORA development work in 2020, 2021 will be the year where we will focus our efforts on full transition of legacy contracts. So what should you be doing to prepare yourselves? MAS has just sent out a regulatory survey to banks yesterday to better understand banks' level of preparedness. From the survey questions, FIs should be able to work out what key steps you should take to prepare for the transition. These include FI's transition preparations should be commensurate with the nature, scale, and complexity of your operations and your exposure to benchmark rates. It is important to carry out an impact assessment to size your benchmark rate exposure. FIs should develop a transition plan that should cover key focus areas, including first, setting up an internal governance framework. The FIs should have an enterprise-wide transition management program across functions and business lines. Senior management should provide strategic direction and close oversight and mobilize the required resources to support the transition. Second, keep a comprehensive inventory of exposure, covering types of products, number of contracts, value of contracts, segmentation of customer types, types of legal documentation, and contractual fallbacks. Third, develop appropriate strategies for legacy book transition and new SORA product development. Banks should develop clear strategies to reduce reliance on and eventually phase out issuance of LIBOR or SOR-linked products. Banks should also work closely with end-user clients on a workable pathway to transition from SOR to SORA. Fourth, enhance systems and infrastructure to support the transition. Systems include treasury systems, loan systems, settlement systems, as well as pricing, valuation, and risk models. Here I want to emphasize that FIs should engage your vendors early to determine the scope of work required and secure resources to roll out the necessary upgrades and modifications as soon as possible. Just bear in mind that the demand for these resources is industry-wide, so better move early. Fifth, formulate stakeholder engagement plans which should cover internal stakeholder engagement and training, external client communication. FI should provide relevant, clear, and timely information to clients so that they understand the risks that they are exposed to and the potential actions they could take. FI should also need to consider the varying levels of expertise across their client segments and to tailor their communication plans accordingly. So that's all I have for now. I hope I've given you a useful overview of the work that we need to do over the next 2 years. There is not much time. and the work will be very involved. But above all, it is critical for the industry to prepare ourselves early and to prepare ourselves well, so that we can work closely with end customers to achieve a smooth and seamless transition. The steering committee will, in the coming quarters, work hard on outstanding issues in order to provide appropriate and relevant industry guidance to support your bank's transition work. At appropriate junctures, ABS will also organize workshops such as this to directly engage industry players and to keep you updated on key developments and work progress. So thank you, and I look forward to a fruitful discussion as we go through the sessions later on today.
Thank you, Sin Jong. And now we move on. We'll invite Matthew Lipney, Global Head of Rate Structuring of Standard Chartered Bank, to make the presentation on derivatives. Matthew?
Good morning. Thank you very much, and thanks everyone for joining the call. So the first session will cover the impact of the transition on derivatives. So what we will cover during this session is how LIBOR discontinuation is impacting SOR or SOR, which is the most commonly used benchmark for $dollar derivatives, and what are the two main impacts it will have. One on existing contracts, so what are we going to do with contracts referencing SOR? And two, how are we going to prepare for future shape of markets based on SORA? And importantly, we'll finish this session by focusing on how can we get ready for SORA-based markets. So, as most of you will know, SOR is based by construction on US dollar LIBOR, and US dollar LIBOR discontinuation, as mentioned previously, is a certainty over the next couple of years. So inevitably it will impact SOR, and there will be a need to replace and find a new benchmark for $dollar based derivatives. So in August 2019, the ABS-SFEMC has identified SORA, which is the Singapore overnight rate average, as the alternative benchmark for SOR for $dollar derivatives. So first, we will cover the impact on existing derivative, because even though we'll try to have a stock of transaction that is as limited as possible, it is very likely that there will still be SOR or SOR-based transaction upon the time of transition. So the time of transition for LIBOR is expected to happen at the end of 2021, and that's very likely when SOR will be transiting as well. So it's important to understand what is a fallback. So a fallback is a contractual arrangement to ensure that existing contract can continue or can survive an event that was previously not planned, such as the discontinuation of a floating benchmark or an index. And surprisingly enough, in ISDA, a lot of benchmark, including LIBOR, did not cater for a permanent discontinuation of the index. So it is very important to amend this definition to ensure that there is a proper suite of fallback into the definitions to ensure that the contracts can continue in case of permanent discontinuation. After a consultation that was launched by ISDA last year, a vast majority of respondents elected or favored adjusted SOR as the preferred fallback for existing derivatives contract. This is actually supported by the SC-STS, and there will be a publication or the publication of the result of the consultation that was run in Singapore coming in the next few months. So how will adjusted SOR be calculated? So the benefit is that it will actually be based on the same logic or same formula as the existing SOR, but obviously since LIBOR is disappearing, we need to replace the dollar rate component that appears in the SOR formula by a new rate. And this new rate will simply be adjusted SOFR, which is basically the new US dollar benchmark based on a daily compounding of SOFR. So SOFR stands for Secured Overnight Financing Rate, and a spread that will be factored in to reflect the difference in maturity and credit risk that LIBOR has, but that SOFR does not. SOFR hasn't. So importantly, this fallback is not yet in the definition, and the typical way it works for existing contracts is that ISDA will publish new definitions, including a full-fledged fallback mechanism that will lead the existing SOR definition to adjusted SOR in case of permanent discontinuation. The advantage is that unlike many other financial documentation, most derivatives will be driven by ISDA, and there is a very useful mechanism called ISDA protocol where every signatory of that protocol can automatically fall back to the new definition. So that avoids sometimes lengthy and complex repapering or contractual negotiation with each of your counterparties. So this is a process that is ongoing, that will affect not just SOR, but most of the other IBOR benchmarks. And it's expected to come up in the next few months as well. The key difference, and that was just mentioned previously, is that adjusted SOR, because of this SOFR component, will then become a backward-looking rate. So by backward-looking rate, it means simply that over an interest rate calculation period, where currently we typically know at the beginning of that period what will be the interest rate for that period. Since SOFR is based on daily compounding of the rate over that period, we will only know the rate toward the end of the period. So it will have it will generate a few challenges, whether it's in terms of planning cash flows, settlement, and all that. But again, there is nothing overly complicated, and I think that's something the market can evolve towards with specific adjustment, such as, for example, shifting the calculation period to cater for a necessary buffer for the payments. So the key benefit of having adjusted SOR, I can cover that briefly because it was covered previously. I think the key benefit is that it is fundamentally similar to what SOR is currently, the way SOR is currently computed. It's following an adjustment to LIBOR that is in line with a global standard and falling back on the same SOFR fallback rate as US dollar LIBOR. And it is expected to minimize basis risk and value transfer when converting existing legacy contract, as opposed to what would have been the case if the market has moved everything to SORA. Some disadvantages or some potential risk is that there will be, for some period, the existence of two SOR markets. One that is basically the existing or the previous legacy contract that converted to SOR, and at the same time the new market that will develop based on SORA. And I think it is important again to stress out that point. The best way to convert your legacy contract is not just to wait for the big bang date and expect all your contracts to shift to adjusted SOR, but it is actually to proactively phase out your SOR exposure and slowly or progressively replace that by SORA-based exposure. So reducing the stock of existing SOR contracts is the most prudent approach. So obviously there will be some challenges because it is a fairly fundamental change in the derivative market. We've listed out some of the key challenges. Obviously, it's not all the challenges, but the challenges that are the most commonly faced or most commonly feared by end users. So I think the first is that obviously derivatives are very often connected to underlying contracts. So fallback language may differ between derivatives and, for example, cash instruments such as loans or bonds. So it is very important to assess and understand the potential mismatches in fallback languages across different products. Linked to that is a basis risk. So a basis risk is simply that one contract, for example, a loan, has a specific fallback that is not the same fallback as what you would see on the derivative side. So again, important to identify early any connection between different contracts and ensure they will still be economically connected later on after the transition. Hedge effectiveness will be, again, linked to the potential basis, a potential issue to be looked after. Hedge effectiveness rely on an economic link between a hedged item and a hedging item. And if the fallback is different between the contracts, there is a risk that hedge effectiveness may break, which requires, again, close attention. If not catered to, it could create some potential P&L misalignment or P&L jump. Valuation movements are something that are important as well, because if you just keep your portfolio up to the last date, basically your contracts will be moved to adjusted SOR and will be revalued to the then prevailing market. So if there is any misalignment between the adjustment rate and the then prevailing market, there is a potential valuation jump, which is basically a change in the value of your derivative portfolio. So it could be a gain or it could be a loss, but basically it is an uncertainty that needs to be factored in, because obviously valuation jump are very important. The operational aspect will be key, because systems will probably need to be changed. There will be a need to engage, I would say, specialists on tax points, accounting points, legal points, and very simply being able to assess all your SOR-based exposure is something that will require a lot of effort and attention. So it's something that, again, we suggest you start doing as early as possible, because the cross contracts, especially for large financial institutions, if you have a mix of derivatives, loans, bonds, assessing your exposure and understanding the risk associated to each exposure is a fairly significant task that needs to be performed as early as possible. So just to give an idea of the size of the market, so it was mentioned before, but it is over a couple of trillions of existing transactions, so it is extremely significant, and I think all of us as an industry need to ensure that we move as fast as possible away from SOR to the new benchmark, to ensure that we reduce, again, as an industry or as markets participants, the overall size of stock of transactions that we have, to reduce the risk of the transition over time. So I think it is, again, important here for banks to play a leading role in engaging their clients, in educating them and engaging them about this transition, as it is something all of us are going to be required to work together. So what's important now to understand is that the derivatives market is going to move to SORA at a new benchmark. So SORA, I will repeat it again because we have a lot of new acronyms coming up. So SORA is the Singapore Overnight Rate Average. It is actually not a new acronym because it's been in place since 2005, but it would be a new acronym in the derivatives market, because derivatives market is currently not based on this index. The fundamental point, just like for other markets, is that SORA is based on a deep and liquid overnight market. So we've discussed about RFR, risk-free rate, and that is what global, I would say, market leaders are moving towards, whether it's UK, US, Switzerland, and so on. Okay, so SORA is in place since 2005, so that's very important also for us market participants, because it gives us a very long time series of data that we can analyze. One thing that makes people fairly uncomfortable when we move to overnight rates is that obviously, whether it's for derivatives or cash instruments, we are not going to move to daily payments with overnight interest rates. Very likely, payments and calculation period will still be based on 3 months, for example, or 6 months. So how do we convert these daily rates to quarterly rates or semi-annual rates? It is something banks will be fairly familiar with, but that end user may not be so familiar with. So it's important to clarify that it's not that complicated. It is simply a daily compounding, which is a sort of averaging of the daily rate over the calculation period. So here we've shown a very basic, simple example based on actual fixings of what would be a compounded SORA rate. So again, a compounded rate is as if you reinvest your cash on a daily basis at SORA for a given period, and how you get to your final rate. So the formula looks a bit complicated, just like any mathematical formula, but once you lay it down and you look at it with a simple example, everybody can understand. So I think that's very important, again, to clarify and demystify for end users the calculation, of compounded SORA. If you look at this graph, I think it's an additional layer of comfort that we should get when we are going to move to compounded SORA. So this graph simply shows or compares your 3 main benchmarks. One is compounded SORA, one is SOR, which is the current benchmark, and one is SIBOR. And what's interesting, as you can see, is that even visually you can see that SORA compounded is much less volatile compared to SOR, which is the current benchmark. So again, that is something that is an element that should give comfort to market participants, that we are moving to a rate that is more stable, that behaves more like what people would think of a typical interest rate, less volatile than SOR. And again, SOR in 2011 turned negative. That's the kind of things we are unlikely to see with SORA. The roadmap of the transition, I think, is pretty clear. The objective of the working group and SC-STS is to ensure we develop a SORA derivative market as quickly as possible, and that means as soon as this year. So how do we get ready for the new benchmark, the new SORA-based derivatives market? And when I say we, it's not just banks. Again, it's how we ensure that all markets participants are incentivized as much as possible to move to SORA-linked derivative. And for them to be incentivized, how do we ensure we have the right infrastructure in place? So I think first, to ensure that people understand how SORA-linked derivatives work, and that's the purpose of such session we are having today, is that definitions are going, actually have already factored in the new SING SORA compound. So the definition was published earlier this month via an ISDA supplement. So that gives comfort that very soon we'll be able to have like standardized contract templates for the typical instruments such as SORA interest rate swap, cross-currency swap, or basis swaps. There are advanced discussion with a major central clearing counterparty to ensure that SORA-linked derivatives are available on clearing. That's very important, as most market participants feel comfortable dealing via such centralized counterparty. And obviously, ensuring that as many standards are moving to SORA as possible, such as, for example, overnight payment on collateral is going to be a key for ensuring adoption or wide adoption of SORA-based derivatives. Lastly, and again, I will reemphasize that for all banks, it is extremely important that we ensure very active engagement of our clients about this transition, to basically educate them and address their questions as well as possible, and get feedback from them on how we can, again, educate them on the key points. Liquidity will be important because obviously for a market to exist, liquidity is required. So the first few swaps have been dealt late last year, and after that a few other trades have been transacted. So I think it is very important again that such liquidity is available not just for interbank but publicly to market participants. So that's one thing. And obviously derivatives exist mostly because there is an underlying active cash market, and that's why the different working groups are collaborating to ensure an alignment of the benchmarks. Okay, I will move to the last slide because I think that's the key part. Again, the key takeaways I would say from my presentation, but I think for today's workshop is please get ready as early as possible. This transition is not optional, is not unique to Singapore, is not unique to SingSOR, but it requires a lot of effort, a lot of commitment in terms of resources. So the earlier you get ready, the better. And I think we'll, as an industry, will ensure that we keep engaging all markets participants about the evolution of the market and to ensure that everybody is ready in time. That's it. Thank you very much.
Thank you, Matthew. And now we have Mr. Tan Ki Pong, Head of Capital Markets, Global Investment Banking of OCBC, who will make his presentation on bonds, perpetuals, securities.
Thank you very much, Aibun. Good morning, everybody. Today's session, I will be covering as subgroup 2, the area of Sing dollar bonds and perpetual securities. In terms of today's session's topics, I would first go through a simple sample of a SORA-based Sing dollar FRN, and also go through some of the key differentiating aspects, of a SORA-based instrument, particularly around the area of what we outline as an observation period and also a calculation period, and then overlay that with an illustration of how would IRS or interest rate swap would look like. And then move on to a discussion around term structure of interest rates, because typically in a deeper and a broader credit markets, you have a basic building block of a overnight rate, and then extending that tenor into various maturities, particularly in the short, medium, and longer term rate structure. And then lastly, I would cover some of the legacy issues that could be impacted by this transition. Now, for example, in the case of a SORA-based FRN, you would see on the slide just some summary terms, and most of them are generic ones, particularly, for example, who the issuer is, what kind of status, and typically in the bond market it would be senior unsecured, direct unconditional subordinated and unsecured obligations. As an example, I've used 100 million Sing dollars as the notional amount. Issue price is assumed to be par, and just for to put the dates in context, I have indicated a trade date of 13 February, and then an issue date or settlement date of 20th of Feb. For illustration, typically for primary issuance, the market operates on a T+5 roughly settlement date. So this takes the trade date and issue date into context. Maturity date, the tenor is assumed to be 6 months, and therefore we have a maturity date of 20th August. Coupon is to be paid quarterly in arrears, and the reference rate would be the Singapore overnight rate average, which is SORA compounded daily. The interest period, or what we call the interest accrual period, would be from and including the issue date, by excluding the maturity date. Observation period, which is something unique to a backward-looking rate regime, for example, we've used the common ones that we've seen in observed in other markets, is look back or a lockout period. Format and denomination, that's typically in barrel format, and 250K is a typical denomination in the wholesale market. Covenants are usually some of them are sometimes available for investment grade, largely not. Use of proceeds is just would be a generic description. Listing and clearing, we can use SGX or CDP, of course, granted that for in preparation for and readiness for this transition, we appreciate that systems and infrastructure need to be ready and in place. Governing law, as typical for Sing dollars, would be Singapore law. Right. So let me go through a little bit of what the observation period with regards to a look-back feature would look like. The time period shaded in green, light green, would be the interest observation period, right? And the interest would start from T, which is 20th Feb, and maturing on 20th August. There'll be two interest payment dates, one on 20th May and the final coupon payment on 20th August. In a look-back feature, the interest rate setting would be, or fixing, would be, for example, T plus 5 in this case. It could be between 2 to 5 business days, as what we've seen in current conditions. It depends on whether systems are ready, whether cash flows can be planned on time. So as an illustration, I've used 5 for this look-back example, right? So with T plus 5 look-back, the rate fixing will start from 13th of February. And to the extent that SORA is available fixed already on that date, you can start using that date. If it's not available yet, particularly in the early morning, and if you so decide, you can use the SORA fixing that's on the preceding day. Right. So essentially, the calculation period then just shifts backwards by 5 days. And you will make the payments as scheduled on the 20th of May, as well as on the 20th of August. On the 20th of May, it will be just the coupon payment. On the 20th of August, it will be both a coupon as well as the principal amount. Moving on to the next slide, the next feature would describe a lockout period feature. And essentially, the difference between this and the preceding example of the look back is that the calculation period will start the same day as the interest observation period. Right? And the calculation period kind of would, in a way, end. For example, now it's 2 business days before the maturity period, or maturity date. And what is essentially done at Y-2, which is 18th August, is that you would freeze the rate of SORA on that date once it's known, and apply that same rate over the next 2 days just before maturity. Right. So in this case, then the interest period and the calculation period will differ a little bit by 2 days. So the rate would be known before the maturity date by moving it 2 days backwards and applying the same rate over those 2 days. In a IRS situation, and similar to the interest rate swap and interest rate swap that we have currently, we envisage that the issuer would be able to hedge its existing SORA-based floating rate interest rate exposure into a fixed interest rate liability, via the diagram and flows indicated here. Right? Essentially, an issuer which would be in the middle box has will need to pay SORA interest rates to bond investors. If the issuer decides to hedge that its SORA-based obligation over that 6-month tenor period, it could approach a swap counterparty, in which in this case is typically a bank, to go into a contractual arrangement whereby they would receive the SORA interest rate that is payable on their SORA FRN from the swap counterparty, from the bank, and in turn the issuer would pay an interest rate of Y to the swap counterparty. And in this way, it's able to hedge the exposure. Of course, the illustration shown over the last 3 slides are in a very simplistic form. As the market gets underway, once these concepts feedback is sought via these concepts features, and we get into a situation of early adopters and execution, a lot of the details would need to be ironed out, and to the extent that systems are ready, not just from an infrastructure and internal systems perspective, but also across some of the other interdependencies, such as valuation, accounting, tax considerations, that we would be able to see the first issuance kickstart this transition. In terms of timing-wise, we would use the first half of 2020 to look at features of how we can develop a issuance around a SORA-based FRN, as well as use the time to look at some of the legacy bond issues that we have that could be impacted, which I will go on to in a little while, and prepare for an issuance in the second half of this year. Right. Moving on to term structure of interest rates. Typically, in a financial markets, a credit market situation, there would be various tenors across for market participants to transact, particularly when it comes to a yield curve discussion, it's really in effect a relationship between interest rates, bond yields across different tenors. It reflects a yield curve reflects market expectations of overall credit market environment across the tenor. In a construction of a yield curve, liquid market instruments are required. Instruments such as short-term cash instruments, medium-term futures or forward rate agreements, long-term swaps, etc. Typically, short end determined using reference rates. In the past, we had LIBOR rates. Going forward, we would be using SORA rates for Sing dollars. The middle part of the curve historically has been using Euro-dollar futures or forward rate agreements, and the far end using mid-swap rates. I think these are examples that we can learn from history and then see how we can use that and apply it when we are constructing a SORA-based yield curve. Of course, risk-free rate instruments have played a big role in this, and in the case of the US dollars, US treasuries are used for that. What would be next then is, as SORA is historically an overnight rate, our industry is working in parallel to develop forward-looking rates, i.e. the construction of a new risk-free yield curve based on SORA. In line with other markets, this development of term rates is in parallel and concurrent, and eventually with market acceptance and adoption, it will become reality. Right. Next, I would like to cover some of the legacy matters that we see in the Sing dollar bond market space. Currently, we know that there are 80 plus legacy issues. That is Sing dollar bond issues that may be impacted by this transition. They are largely comprised of Sing dollar perpetuals, bank tier 2 securities, and some floating rate notes. Since then, 4 have matured or have been called back, and we've done a survey of these legacy issues, and the work is divided among 6 banks that are active in the Sing dollar bond space. A survey table has been distributed to the banks from the end of last year, and the objective of the survey is really to look at in greater detail the type of fallback mechanisms in these issues, so that such that when the transition occurs, these legacy bond issues can either continue or has a fallback that would minimize any disruption. We will also work on public comms and timing of how these issues can be addressed. Since then, there have been 5 new issues since the survey commenced, and we are also reviewing as to what the fallback mechanisms would be like. Essentially, for purposes of classifying or categorizing the legacy issues in terms of fallback language, we've grouped them into 2 types, type 1 and type 2. Essentially, type 1 are those that would not envisage a change of reference rates. Type 1 is basically issues that have that reference SOR as the reference rate, and it does not envisage a change of reference rates. So certainly type 1 to the extent that when the transition happens and issuers want to continue, certain actions will need to be looked into. Type 2 is where there is potential options that they can rely on in terms of the documented language that they can accept or accommodate a situation where the reference rate has changed. But certainly we would need to look into the details and terms and conditions of each issue so that we can recommend or discuss and explore the right approach to take in terms of continuation of those issues when transition occurs. Right. So with that, that brings us to the end of my presentation. Thank you.
Thank you, Kipong. Before I call on Philip to make his next presentation, we received a question from a participant inquiring if the slides will be made available, implying whether they can get hard copies. The short answer is no, but the long answer is yes, you will be able to view it because we have recorded today's workshop presentations, and together with the slides, this will be available for you to review, to revisit the presentations with effect from Saturday. We will give you the URL and the password code, and it will all be available, but the slides will not be able to be downloaded, but you can view them. So that's the long answer to your question, okay? So now, my pleasure to invite Philip Fernandez, Corporate Treasurer of DBS Bank, to make the presentation on business and syndicated loans. Philip, please.
Thank you, Ibun. So in this part of the session, we'll focus more specifically on the impact on business and syndicated loans, which is really the other part of the cash market. So Kee Fong has already talked about the bond market. So this is now looking at some of the more specific issues that the loan market will face. So there are 3 main areas we want to cover today. We want to guide the industry in addressing today's SOR loans, shaping the conventions for tomorrow's SORA loans, and driving early market adoption. So within the working group, the work has also been split along these 3 lines, and I'll walk through each of these 3 areas in the next few slides. But very briefly, what's going to happen to existing loans? All lenders will need to review the fallbacks in the SOR loans. The steering committee is going to publish some guidance on SOR fallback for loans. Seng Chong mentioned that earlier. And lenders will have to engage customers on choosing a replacement rate for existing SOR loans. I'll drill down on that later. For new loans, what's quite clear is that we need to develop conventions for SORA-based lending that fulfill borrower needs. So there are quite a few details to work through, and the steering group is working with the industry on that. The third point, which is quite important, is really how do we drive market adoption of SORA in the loan market? Because the derivative market will not take off and will not get price discovery unless the loan market also switches on at the same time. So it's important for banks to engage some early adopters among the corporates, kickstart the SORA loans, and obviously to do that, we'll need to develop the key enablers required for SORA lending, such as the systems. So let me take those 3 points on existing loans, new loans, and early adoption, and let's drill down a little bit into that. So just as by way of background, before I do that, on the next slide, what do we have currently? What's the landscape right now? So very simply, business loans at the moment are either fixed rates, so you know what your rate is at the outset of the contract. They could be administered, for example, cost of funds. Some banks have still got prime pack loans. Those are administered by the banks. And floating rate loans, at the moment, we have SIBOR loans and SOR peg loans. So that's the landscape as it is today. What's going to happen going forward? So going forward, there is no change really to the fixed rate and the administered rate loans. And really the changes are happening on the floating side. So let's focus on SOR, and I've sort of scratched it out to indicate that really will be replaced by SORA. And that is really what will happen. We will have to do the fallback for the existing loans. And for new loans, we will basically go to compounded SORA first, and hopefully over time to term SORA. And related to that then is how do we drive the market adoption of SORA? So let me make a few points on the legacy SOR loans. And I think this covers some of the points that Sing Chong and Matthew mentioned earlier on. It's very preferable that legacy SOR loans are repapered before SOR discontinues at the end of 2021. And just to reinforce the point that was made earlier, SOR is going to get discontinued when LIBOR is discontinued. As Sing Chong said, that train has left the station, and this is happening. It may occur as early as 31st December 2021. We have no reason to suppose that deadline is going to move. And definitely any SOR loans that are maturing after end 2021 ideally should be repapered to an alternative benchmark before this happens. So we don't want to carry over a large legacy book past 2021. We recognize there might be a few cases that we have to handle, but on the whole, we are really recommending banks to work with customers to repaper these loans. So if they're not repapered, what happens? If they're not repapered, so this is where the loan market is different to the derivatives market. In derivatives, ISDA has a global protocol, and the fallback rate will just kick in for all contracts. So the global protocol is an efficient way of amending all derivative contracts that are outstanding. But loan contracts are typically bilateral, or in the case of syndicated loans, between a group of banks and a borrower. So if they are not repapered, when SOR discontinues, the interest rate will fall back from SOR to a different rate specified in the contract. So this will really be a case of looking at each and individual contract, just like Kee Fong was talking about the 80 bonds that are legacy bonds. Similarly, in the loan market, we have that problem, but on a much larger scale. So the steering committee will publish guidance on the fallback rates for legacy SOR loans later this year, including adjusted SOR as a possible fallback. The rationale, again, I think MES has walked through that and explained that it is the closest substitute we can find. But do bear in mind the other point that was made, that adjusted SOR itself is very likely at the outset to be a backward-looking rate as well. So the steering committee strongly encourages lenders to adopt a common approach for transition of legacy SOR loans, and borrowers to work with lenders to transition their SOR loans to different benchmark before end 2021. And that's why we're having this workshop early, to give everyone time to make preparation, have discussions, and so on. So you will see this as we walk through the different sessions today. So what happens to new loans? So moving to the second section of my presentation. Firstly, I just want to lightly touch on term SORA. And term SORA is really like SOR. So if you look at the line below, your SOR loan is fixed in advance. So at the beginning of the period, you'd fix the rate that prevails for that period. And if we have term SORA, it will also work the same way. To be quite clear, some borrowers will like it because it works just like SOR, but some borrowers may not like it because SORA derivatives which reference overnight SORA, may or may not hedge term SORA effectively. But also bear in mind term SORA's publication depends on a deep and liquid SORA swap market, and that's precisely why we need to kickstart the market. But at the outset, we should not assume that term SORA will appear. We should work on the basis that we're going to work with compounded SORA, which is really what I have on the next slide. And this is really, I think it's been explained before, but just to make it very clear for the loans market, it's the realized average of each period's SORA rate in arrears. Obviously, there are some finer details. Kee Fong mentioned some of those for bonds, that we freeze the rate for the last 2 days and so on. But broadly speaking, we will only know the rate at the end of the period. So then again, the feedback that the working group has had from the different banks is that some borrowers will like it, and it's obvious from the graphs you've seen earlier that Matthew has shown. It is less volatile than SOR, precisely because we have this averaging effect. And the second important point, and I think in the later subgroup on accounting, we will talk about this, we can hedge it more effectively using SORA derivatives. So this is a very important consideration, and we do ask all the banks to bear this in mind. On the other hand, there will be borrowers who don't prefer the fact that the payment is known until the end of the period. So there are some drawbacks, and we're just being transparent about that, and we need to discuss how to support such customers. So roughly in terms of timelines and what we need to do, so we're focusing a lot more on the preparation for getting the loan market ready. The rate sort of timeline, we have talked lightly about it before. SOR will end at the end of 2021. Sometime before that, we may have to cease origination of SOR, similar to what the UK market has done. We will look into that. And adjusted SOR will start getting published, and it will be a fallback for any loans that do not get repapered. Overnight SORA, as mentioned, has existed since 2005. So this rate is well established. It's a liquid benchmark. And what needs to be published is actually compounded SORA. So we're working through the conventions. MES is working through the conventions with the industry on how we will publish compounded SORA, and that will make it easier for loans to do. So more important, I guess, is to focus on the 3 horizontals at the bottom, because the timing for doing a lot of this work is fairly tight. So lenders will need to engage customers with SOR loans. We have to look at the fallbacks. There may need to be amendments to the clauses. We will look at whether there's an efficient way of doing that. The system and the processes, MES has sent out the survey, as mentioned earlier, for all lenders to review the readiness for compounded SORA. And it would be good if there's a parallel run for the compounded SORA so that people are just comfortable with the transition. And the new products, again, as Kee Fong mentioned, the bond side, on the loan side as well, we're going to try and get out some early adopter trades on both bonds as well as loans to kickstart the market, just as the derivatives market has kickstarted with the SORA OIS swaps. So the new loans will then reference term SORA if available, but let's all work on the assumption that it will be compounded SORA that we will have to kickstart this market with. So you can see that quite a lot of work needs to be done between now, starting now, and really becoming ready in within 2021. So then turning to the third and final point in the presentation, how do we increase market adoption of SORA-based loans? So obviously this presentation, the sharing from all the groups is a first start. So everyone is clear about the direction of travel and what's happening. The subgroup 1 has mentioned that there have been already 2 SORA swaps that have been done, and subgroups 2 and 3 are working on early market adoption, starting the new SORA loan and bond market by end 2020. For lenders, obviously you have to review existing SOR loans, work through the inventory, and in particular hedge loans. So the transition for the loan and the swap ideally should be aligned. That's another very important point that banks should take note of. And preparing systems to be ready for compounded rates. Again, we want to avoid a rush right at the end when vendors are being pulled in multiple directions by multiple banks. And for banks where your technology support is outside Singapore, you may have to put a request early to get a budget, get priority for this particular system change, parallel run user acceptance testing, and so on. And obviously, please provide feedback to the MES Financial Benchmarks Transition Survey so that at the industry level, MES has an overview of how ready the industry is for this transition that will take place. For the corporates, which we've got a group tomorrow on, the point is really to check if you have existing SOR loans and expect your lender to reach out to you in the next few months to discuss the next steps. There's a whole protocol on how this communication will happen, and it's being coordinated at an industry level. So I thought I'd leave you with a slide that's just useful in terms of wrapping up all the different actions that need to be taken, because we've spoken about quite a few different things. So to summarize it, definitely customer engagement, making sure that the corporates are very clear about what's going to happen, and they understand and have a chance to walk through all the changes, and they're clear about the impact, not just on the rates they're paying, but on hedge accounting and valuation and so on. And in order to do that, we have to work on 2 tracks for the products in terms of dealing with the legacy products. That's point number 2. And point number 3, getting the new loan products to the market. And in order to get the products out, there are broadly 4 categories that we need to deal with for business loans. On the rates, how do we take in and process the new SORA rates? Unlike the treasury systems, a lot of the loan systems do not handle rates in arrears today, so there's work to be done on that front. The new products will have to be set up in systems, curve assignment is done, so on and so forth. Then on the contract side, and Chikin will talk about that later, really the contract review and remediation. And finally, we'll also have to look at the accounting, the valuation, and unlikely there'll be major tax impacts, but we put that in for completeness. So hedge accounting is a big issue, but I won't dwell in that because there's a separate session that will drill down into that. So that's what I have today, and thank you very much.
Thank you, Philip. And now we have Lawrence Loh, Head of Group Business Banking from the United UOB Bank. Lawrence, please.
Thank you, Aibun and Philip, and good morning everyone on the line. So SG4 has been formed to look at all matters of consumer products affected by the SOR to SORA transition. And based on our understanding of from the earlier ABS survey conducted last year, the impacted consumer products that may use SOR as a reference benchmark rate are property loans, structured notes, and bonds. However, as the earlier survey may not have captured all the respondents' feedback, there could be other loans that your institution may offer that are also pegged to SOR. If that is the case, a similar approach to the property loan will apply. As SORA has been picked as a transition benchmark rate for business segment cash product as highlighted by SG3, SG4 has to consider a more transparent and familiar benchmark alternative other than directly adopting SORA, given the general consumer lesser maturity in their understanding of SORA. More familiar benchmarks such as SIBOR or SIBOR Plus are benchmarks that were considered alongside SORA at the moment. However, the transition testing from SIBOR to SIBOR Plus is still ongoing and extended till June 2020, as it is necessary to observe data over a longer period of time. As such, for property loans or other equivalents, we need to be ready to be transitioning into either SIBOR Plus, SORA, or other bank board rate. It is also important to note that it is also not mandatory for banks or institutions to come up with a replacement benchmark rate product pegged to SIBOR Plus or SORA. They are free to transition current SOR customers onto an existing loan package if they wish to do so, and if their current T's and C's allow that. This should be a business decision. On the reference benchmark of whether it is going to be SIBOR Plus or SORA as a replacement benchmark to SOR, we should have better clarity by the end of the first half 2020. For investment products, however, the replacement benchmark rates will be decided by the issuer, and this will likely be SORA. Respective institution will then be responsible to communicate to their consumer customers on the change of benchmark reference rate of their investment product, and this should be similar to that of existing corporate action process. As this SOR product transition is involuntary for consumer and have impact on affordability computation or logistic documentation fulfillment, SG4 has gotten MAS approval for a one-time waiver for both TDSR computation as well as the property loan fact sheet treatment as required by the MAS. On top of consumers that have selected to transition to a replacement benchmark rate loan package, this one-time waiver will also apply to consumers selecting a replacement loan package offered by the same bank. However, getting a loan package from another bank, it is not permitted. Specifically on the property loan fact sheet traditionally required by MAS 632A, a generic or a abridged version containing key features of the loan, including fees and charges, should be provided to the borrower. The borrower explicit acceptance through a signature, which is required now, will be waived off for one time. MAS will also, after this workshop, issue a consultation response, and SG4 will share this as well as formal guidance on operational details at a later stage. Moving on to areas to note to assist you and your institution to be ready for the SOR transition for consumer products, there are several points to look out for, and SG4 in the coming months will provide a transition template for the various institutions for your reference. Let me go through these areas quickly. First of all, you need to identify the range of products within your institution that are pegged to SOR and be updated on the possible transition benchmarks. Areas such as the systems impacted on how to accommodate the new benchmarks, how you want to price your loan, and the accounting and tax approach should be established. You should also establish timelines and deliverables to be kept in pace with how the industry work out the SOR transition. On this, I'm sure there will be ongoing communications by ABS and MAS that you can keep abreast of the latest updates. With all the other SGs also mentioning this as well, SG4 no different. Do review all your terms and conditions of all your loan contracts to assess the impact of the discontinuation of the SOR benchmark rate. You need to ensure that your IT systems are able to handle all the operational as well as processing functions when the new reference rates are being put in place. Last but not least, we need to ensure that communications are done with your board, senior management, as well as internal staff and the external customers on the SOR transition. On this point, SG4 has actually issued out a customer letter template to all the banks as well. Thank you, and I hope that you find the above information useful.
Thank you so much, Lawrence. And thank you, this morning's presenters, for your very efficient delivery, and we are ahead of schedule of time. Nevertheless, we'll have a break now, and we'll come back on schedule time at 10:50, because there will be some participants who will join us then for the second half of the session at 10:50. So we'll have a break now and see you. We'll start punctually at 10:50. Okay, we're on for the second session of today's workshop, and thank you for joining us again. We now have pleasure to invite Lam Chi Kin, Managing Director and Head Group Legal Compliance and Secretary of DBS Bank. He will make the presentation on the legal documentation impact to banks and customers. Chi Kin, please.
Thank you very much, Mrs. Ong. So for this section, I'm just going to take a little bit of a step back because this is the first subgroup that has a level of horizontal responsibility. You've seen the flow of today's presentation. We've started with an overview, and then we've gone into vertical product by product analysis or segment by segment analysis. And this is the first of the horizontal work groups. So legal, communications, and accounting and tax are horizontals. And that's a really good way to think about the issues associated with this project, which is you start with a big picture, and then you analyze it by products, and then you look at the horizontal impact. And then after that, the horizontal impact can also create impact onto the products, which then affects the overview thinking. So what I'm going to do in this section is to just run through some umbrella legal thinking around how we approach the legal issues. I'm going to identify 2 or 3 issues in the legal area that has impact on the products. And then after that, I'm going to go through a current state of the product by product analysis on how we're approaching or thinking about the legal issues. So hopefully with that background, that gives some context to what I'm going to be talking about. So diving in, if I go to the next slide, what we are thinking about fundamentally from legal is to be sure that we have a comprehensive inventory of all our impacted contracts in our products and our segments. So what happens here is you're trying to look for all SOR referencing business. And this would literally be all the segments that we've talked about so far, but also being conscious to how the segments can vary. So in derivatives and bonds, you do have a degree of documentation homogeneity, whereas in consumer, you have slightly less, and in corporates, you have a very, very wide range of heterogeneity in the documentation. So what's necessary is for us to then first identify all these contracts and then get into the next level of detail, which is if SOR is impacted by the cessation or the non-representation of US dollar LIBOR, then what happens to my underlying contracts? And that therefore just doesn't need us to just identify the contracts, it also needs us to be in a position to determine what happens to each class of contracts. This is potentially very operationally cumbersome. So without getting into marketing, I do want to highlight that several large or more mature institutions have also resorted to software tools. And what these are basically contractual clause recognition software that can actually trawl through a whole bunch of digitized contracts and pick out the SOR references and the fallback clauses that are related to those contracts. So it's a more efficient way of dealing with the issue, a more practical way, rather than having an army of lawyers trawling through contracts. So that's one of the things that I would flag as being relevant for this. And then with this inventory, we are in a position to move on to the next piece of work, which is to create a transition plan and a going forward plan for each of these classes of contracts. We clearly need to deal with legacy issues, and each of the preceding subgroups has already covered legacy issues. And then we need to deal with going forward issues, which is kind of like how do we deal with standard templates for each class of contracts on a going forward basis, which rate will they reference, and so on and so forth. I highlighted a practical issue before, which is actually the operational burden of assembling that inventory and understanding the fallbacks or the impact on that inventory. There's another operational issue here, which is that if we contemplate a class-by-class repapering exercise across all the product lines that we have, that is also very operationally cumbersome. So one of the things to watch out for here is how we cushion the impact of repapering and minimize the prospect of protracted negotiations as to what those contracts will be. Clearly, the strategy can differ from bank to bank, and clearly also each each set of lawyers that you have access to will advise you accordingly as to how to do it. But I would say that one of the umbrella considerations here is how to cushion the impact. Now, we will definitely work quite hard at SC-STS, so the steering committee, and SG5 in particular, on creating as many as possible contract templates, reference documents, client communication letters. We'll do a lot of collaboration on this so that it will be quite clear also that this exercise is not just a bank by bank exercise, but there's a level of, in a sense, industry coordination in order to get us into both a fallback position that is clear and also a going forward position that is clear. And I'll cover some of this a little bit later as well. The third thing to be aware of in terms of preparatory work is that there are a number of industry associations that are being engaged in this exercise at the same time. So in addition to the work of the steering committee, we are also engaged with ISDA, ICMA for capital markets, and APLMA for loan markets. What this does is it helps us then engage and co-develop standard templates with these industry associations so that these new templates become the accepted normal. And that will also help to cushion any impact of, let's say, renegotiation issues. Okay, so in a very, very quick summary, this is the preparatory work that will be appropriate in the legal segment. I'll go a little bit further into documentation and related options. The next slide, which covers, in a sense, some of the things that we're currently thinking about. SG5, which is this legal subgroup that I'm helping out with, will definitely help with the development of new industry templates, right? So actually, overnight interest rate swaps, cross-currency swaps, basis swaps, and then even standard templates for loans, bonds, floating rate notes going forward. We will be very engaged in trying to standardize industry templates for this. Another issue is in relation to how we kind of like help along transitional matters. SG1, Matthew has earlier said that in the ISDA, there is a very useful protocol, which is that ISDA will publish a transition protocol. And this is particularly relevant for the transition into a fallback of adjusted SOR. And basically, everybody in the industry can sign up to this protocol. And when they do, then actually that automatically amends the contract. So we don't need to go through this contract by contract. These protocols are very, very suitable for derivatives. There are some equivalents in the loan markets and the bond markets because these markets have got some degree of template standardization because of the work of associations that I talked about earlier. Okay, so we are going to put in work to also introduce into the standard templates from these associations how to transition loans and bonds. However, we are still going to have to face up to the fact that we'll have to engage customers, and customers will be engaging with us in relation to the transition and also the going forward position. And we need to expect that this will affect us in the consumer segment and also in the corporate segment to a slightly higher degree. Now, in the consumer segment, actually standard letters is very likely to be the way that we'll proceed. In other words, we'll be writing to customers and basically saying this has happened. And given that this has happened, then the industry has aligned to a transition into this fallback or into this type of going forward option. And there are two options available for us here in terms of the legal analysis. The customer could accept this by counter signature, or there's another option, which is the customer could accept this by conduct. In other words, all you need to do is to continue to service your loan by making interest rate payments. And if you do so, then we will take it that you have accepted the amendment. So these are things that, again, we're trying to introduce so that we can cushion the impact of the repapering. In the corporate segment, however, given the wide range of corporate customers that we're dealing with, we think that it's going to be quite inevitable that there'll be a level of bilateral customer negotiations here. So while the standard letter approach may be feasible for some types of corporate customers, it may not be as feasible for other types of corporate customers. Again, we'll do our best to standardize customer communications templates rates, but I think we do need to expect that in certain types of corporate customers, there will be a need for engagement, and that will create capacity requirements for our front office and for our legal people. I think it's appropriate that we anticipate this. I'm now going to turn on to two specific legal issues, which I alluded to earlier, that create impact for product segments and also affect the way that we're thinking about the big picture. The first issue is hedge accounting, and Mikkel will go into this in slightly greater detail when SG7 does its briefing. But what we have understood to be the position is that in an ideal case scenario, what you want is synchronization. And what this basically means is that the cash contract, which is the loan, and the derivative that is hedging that loan. In order to preserve, in an ideal case scenario, hedge accounting treatment, you need both of these contracts to transition to the same rate and at the same time on the same date. Now that's the ideal scenario. Now if we don't achieve that, then you get potential P&L impact in the hedge accounting. Again, I'll leave this to Mikkel to deal with in a little bit of greater detail. But it does create also a synchronization issue, because then the derivatives market and the loan markets and the bond markets should actually move together in order to preserve our desire for meeting the ideal state scenario. So that's what I would call the synchronization issue, which is in order to achieve and preserve hedge accounting treatment. Okay, so that's point number one, to sensitize everyone to. Basically, the takeaway operationally is make sure that your cash and derivatives transition is aligned. Secondly, and this is alluded to earlier as well, right? So when Sing Cheong did his part of the presentation, there was a question about whether or not the FCA may declare LIBOR unrepresentative before the actual cessation date of LIBOR. So even before we have a permanent cessation of LIBOR, there is a risk that if the LIBOR rate or any other IBOR is considered unrepresentative, then this may actually trigger a need for a fallback even earlier than that. This we call pre-cessation, i.e. a trigger that affects the fallback scenario even before the permanent cessation of an IBOR. Now what's happening here is that it's been identified as an issue by ISDA, and we do expect ISDA to have another consultation as to whether or not to do pre-cessation. Now you can now see how the issues start to interact with each other and introduce a degree of complexity which then affects the big picture thinking. Because pre-cessation then potentially, if ISDA agrees to adopt pre-cessation, then the derivatives market will have both a fallback kind of issue and also a pre-cessation type of issue, which then affects hedge accounting, which then affects the way the cash markets will proceed. Okay, so I am identifying these risks so that people are aware of these types of issues. We're not kind of like closed off to the fact that we'll need to think through the complexity attached to these issues. But I think it's also good to be aware of the fact that actually SC-STS is now working on these issues, and we will communicate further as we land on positions in due course. And the final consideration that I've kind of highlighted here is fundamentally we do need to think about capacity. So it's not just systems capacity or systems amendments capacity, it's also capacity for client engagement, it's also capacity for lawyers, right? Your legal departments may also need to think about how they resource up for this project. Okay, so I have about 5 minutes left. And I'll just go very, very quickly through. Many of the product by product issues have actually been highlighted already previously. But very quickly, the current thinking for derivatives is that we will have an ISDA protocol in relation to fallbacks. The current date of publication of that ISDA protocol is currently thought to be either the end of Q2 or Q3 2020, which means this will come out second half 2020. Secondly, in terms of going forward, SG5, the legal subgroup, will really be publishing new definitions. It's already available. We have Sing Dollar SORA compound is already available for derivatives, and we're currently working on other standard templates to be incorporated into ISDA documentation. So that's derivatives. Moving on to bonds, Kee Fong has actually covered this. Fundamentally, the fallback issues bucket into, for ease of reference, type 1 and type 2. There's still a degree of variation between type 1 and type 2, but they kind of bucket into these two types of areas. Okay, and in essence, the type 2 fallback is more ready for transition because of the reference to an independent rate assessor. But whereas type 1 is not so suitable. So I think we do need to kind of like make sure type 1 either amends or closes out before LIBOR cessation or SOR cessation, and type 2 kind of like is the going forward position. And we will work with industry associations to kind of like standardize type 2 fallbacks on a going forward basis. For corporate loans, as alluded to earlier, there's a very wide disparity, including reference back to bank cost of funds. In generally, in order to kind of like preserve the ideal desired state for hedge accounting, we should transition to the same fallback. So if derivatives are basically falling back to adjusted SOR, then actually the cash products should also fall back that way. Either that or move to a different type of fallback rate, but also preserve, in a sense, the hedge accounting with the derivative. As we move forward, the question will be how the loan segments prefer different SOR replacements, and as these are identified, we will have to develop new industry conventions, again, templates for these new standardized terms. This one, I do want to flag that, you know, I think we're very aware of the fact that there are options available, and the question is kind of like where will the industry land on in terms of the best options for each customer segment. It really does come down to, in a sense, the correct position for the industry. And last point, Lawrence has already covered for SG4, the MAS treatment for consumer loans. The only reason why I'm saying here collaborate with MAS is that MAS still has to publish the actual thing. It's not us that represent MAS here. MAS has to issue the clarity, and they will do so. And then finally, we may have ultimately new SORA loans when actually other types of options are available, compounded SORA or term SORA. We may be able to issue new SORA denominated products for the consumer segment. Thank you very much. That concludes the presentation by SG5.
Oh, thank you. Thank you, Chicken. And now I invite Mikael Larsen from DBS Bank. He's the head group tax and accounting policy of DBS. Thank you, Mikael.
Thank you. Good morning from me as well. So in this final section, we're going to be looking at the accounting and tax consequences of the reform. Before I get into the detail, it's probably worth mentioning that accounting is the outcome of what is happening in the transition that we've heard about in workstream 1 to 5. And as such, I'm going to try and pick up as many of the threads that we heard in those presentations that went before me. And tax, in many cases, follow the accounting. So similarly here, whatever you heard in the first workstream presentations I'll pick up on. The second thing I want to mention is that there's a number of accounting issues that you could contemplate. I've tried to focus on the ones that are likely to impact the most. But I hope you will have Q&As afterwards where you can ask questions around more specific issues that you picked up maybe before coming to this session. Most of the accounting issues will be around the transition legacy positions, so I'll be focusing on those mainly. So the first thing that's worth thinking about is what actually drives the accounting and tax. And in Singapore, the rules are such that the Singapore accounting standards are driven very closely by what is happening in the global arena, with the standards being set by a standard setting body called IASB, and the standards are called IFRS. And IFRS have already given a number of guidance, both in terms of what happens before the transition and after that transition. In very broad summary, the idea is to make it as painless as possible to have this transition, and therefore the hope is that you won't get caught by some of the tricks that you could otherwise end up falling into and experience some P&L volatility. From the tax side, the rules are obviously guided by the Indian revenue, and therefore when I get to the tax part of it, we'll be looking at what the potential tax implication could be under IRIS rules. So I'm going to break the presentation into two parts. Hedge accounting first, and then a number of other issues. I'll do it like this because reality is that hedge accounting, as you probably heard from some of the presentations that went before me, makes up the largest part of the considerations that you would have to go through from an accounting point of view. And they're also the most complex ones. So if I start up, maybe it's worthwhile just giving a brief recap of what hedge accounting is. And I should say, before I go into the details, that some of those on this call will have been transitioning to new accounting rules that's called IFRS 9, and they will have a slightly easier time than those that haven't transitioned and are still therefore on the accounting standard that's called IAS 39. I'll try and explain both of the issues under both of these accounting standards. But just taking a very simple example, imagine we have a floating rate loan that is hedged into fixed with a perfectly matched swap. And when I say perfectly matched, I mean basically the same tenor, the same payment frequency, and of course the same reference rate. And that's really what hedge accounting is all about. When you have those perfect matching of terms, you should achieve perfect hedge accounting, and therefore, if you should therefore not have any mark-to-market. Mark-to-market arises if you don't have fully matched terms, and therefore the mark-to-market on the derivative in this example of what's called a cash flow hedge would have to hit your P&L. That's what we are trying to avoid. So if you look to the left-hand side of this slide, you'll see a graphical representation of both the fixed to floating swap and the original loan. And as you can see here, the two SOR rates knock off against each other, and therefore you'll end up paying fixed. So if you look to your right hand side, you can see that under the swap you will have a receive SOR and pay fixed, and under the loan you will have pay SOR. So the net cash flow is a pay fixed, relatively straightforward. The earnings analysis will reflect exactly the same thing. You will end up paying net fixed, and you should have no mark-to-market ineffectiveness. Essentially, that's how hedge accounting is meant to work. Now, if you want to preserve that type of situations, you really want with this transition to stay perfectly matched. The implications of not being perfectly matched may not be dramatic, but you will very likely experience some kind of P&L volatility. And when I say stay fully matched, I basically mean you want the fallback rate for the loan and the derivative to be the same, either adjusted SOR or SORA. You ideally want the timing of the transition to be the same for the loan and the derivative. And in a perfect world, you would also want both of them either to be forward-looking and backward-looking. And perhaps most notably, you would want to avoid having renegotiating your loan at the point in time where you have to repaper it in such a way that you fail certain accounting rules that's called derecognition, and I'll come back to that. If you manage to do all that, you effectively should be able to continue hedge accounting. And that's what the next slide tries to illustrate, a situation where both the loan and the derivative falls back to adjusted SOR. And as you can see on the left-hand side, all that happens here is that the curve, of course, changes to adjusted SOR, but still everything is matched. And so to the right-hand side, what you will have is you will again end up with a net cash flow that shows that you are paying fixed, and you should have little or no ineffectiveness. I say little or no ineffectiveness because I am aware that in the case where you could have cash settlement, for example, of the swap, but no such similar thing on the loan, you might have some degree of ineffectiveness, but it shouldn't be material. So in a different situation where you do have different fallbacks rate, things will look, of course, differently. So in this example here, the loan falls back to cost of funds, or you could have had SORA, but the swap falls back to adjusted SOR at the same time. So on the left-hand side, you will start to see now that the curve starts to look different on the right-hand side of the picture, and therefore on your right-hand side, you will end up in a situation where you would be paying fixed as a result of the swap, but you will also have an interest differential because you have different rates on the loan and the derivative. Now, from an earnings or P&L point of view, you will see the same interest differential showing up, but you will also have ineffectiveness. And this ineffectiveness will be the difference between the mark-to-market on your actual swap and the mark-to-market on what's called a hypothetical derivative, which is meant to represent the terms of the cost of funds. Essentially, to keep it relatively straightforward, because you have different rates, the difference in those rates on the loans and the derivative for the remaining tenor of this hedge relationship would be the one that you would see in P&L as ineffectiveness. So this is definitely something you would want to avoid, if at all possible. In a different situation, you may end up going back to the same fallback rate, but you would have different timing. The issue here is technically the same, but the implication might be a lot smaller because you're dealing, hopefully, with a relatively small timing period between the fallback of the derivative and the loan. So you will see that in the left-hand side as a difference in the short middle part of this graph here, where you see that you'll have additional volatility. You can see that represented by the orange curve. And on the right-hand side, you will see a very similar picture, some of the one before. For that period of time, the interim period, you will have an interest differential until they both move on to the same rate, and you will have a degree of ineffectiveness in your income statement. I say that this is a smaller issue, and I want to repeat it because in this case here, it should be a temporary problem because you have only a break in a shorter period of time, but you will have some volatility. Now, a related topic to hedge accounting is what happens to the loan that you are modifying. So when you come to repapering this, what is of critical importance is that you consider only changing terms that are directly related to the transition to adjusted SOR or SORA. Because if you don't, what may happen is you may end up having to take that loan off your book and recognize a new loan, even if it's only a repapering exercise. The implication of that could be a P&L effect, and it could also have system implications simply from having to remove one balance sheet item and put a new one on. So wherever else possible, it is preferable that you only renegotiate, you don't take the opportunity to renegotiate terms that are unrelated to the LIBOR reform. Now, similarly, if you were to have derecognition, other issues that I will mention briefly could arise. What could arise is that for those of you, we have rules around the impairments of loan. Technically, what will happen is that such loan, if they were in what's called stage 2, which means that they have suffered some kind of credit deterioration, would have to move back to what's called stage 1, which is give rise to both disclosure issues and accounting issues. If you only negotiate, if you only change the loan as with respect to the transition to adjusted SOR, the implication is simply that you will change your effective interest rate on a prospective basis. So moving on to the other issues, these are those that are outside hedge accounting, and many of them have been covered by other work streams. So the first one is, of course, we talked about the cyber reform. Here, the logic is that in the same way as I just talked around loan modification accounting, you could have that as well in a transition from cyber to cyber plus. Logically, you could also have valuation issues, and should you be in a situation where you wanted to hedge cyber with, say, a SORA-based derivative, you would face some of the same hedge accounting issues that I talked about before. I also mentioned cross-currency swaps for those of you who may have those on your books. The issues are technically the same as the ones I mentioned before, but you're now faced with the issue of having two transitions for two different currencies and two different interest rates pairs, which may not be in tandem, and you would have a number of other issues therefore to deal with. just as I mentioned in my hedge accounting slides. And then finally, all the other things category. Essentially, in any type of accounting consideration where you have used just SOR, or technically any other type of benchmark rates that is now transitioning, you would have to consider what you do when SOR is no longer in existence. You would effectively have to replace that. One example of that could be your impairment test. Another one could be by how you discount your provisions. I think as a smaller subset, it could happen in these liabilities that are pegged to a benchmark rate, including SOR. And there could technically be a number of other areas. So the advice here is to go through all of those accounting areas where you may have used SOR and think about what will you do when SOR is no longer in existence. And finally, I would have talked about the system issues, but I think both Matthew and Philip had talked quite a bit about that, so I'll just reiterate what they say, that when we get to a situation where we have adjusted SOR or compounded SORA with area fixings, this may not be something that your systems can cater for. Obviously, both your trading systems and your core banking systems would be impacted, and this is something that requires due consideration. I won't dwell much more on this slide. And on my final slide, I wanted to mention tax. I have kept this to the end because I actually think that the implication on tax should be relatively limited. The reason is that IRS generally follows the accounting, and therefore what I've just explained to you about the ineffectiveness that could give rise to P&L volatility, change in interest rate, or any of these other terms, insofar that they hit the P&L, our expectation is that they will be taxed accordingly. And by that I mean that they will also be taxed into the category of loans and derivatives respectively. And for the part that gets subject to hedge accounting, the treatment will follow that of the loan. A minor issue, but I should mention here that just to be certain, there might be a need at some point in time to make sure that IRS give a positive confirmation that the transitional P&L is indeed, as I suggested will be following the accounting. Another issue just to be mindful of, that some of you may have done your transfer pricing based on SOR or more likely US dollar LIBOR, and insofar that you have, you may need to change that documentation to cater for the fact that SOR and US dollar LIBOR or whatever else benchmark rate you've used is no longer in existence. And then finally, just for absolute completion, I have talked about some of the issues that we've heard come up in various industry calls. Some have suggested that you might find stamp duties if new contracts have to be, when something is repapering and it leads to a new contract. Some have talked about withholding tax and ESA termination. I think these are issues that I think are much smaller in terms of the overall impact here, but if some people have questions around them, we can deal with them in the Q&A at the end. And I think with that, I think I'll finish.
Oh, thank you, Mikael. Well, ladies and gentlemen, we've come to the end of today's workshop, but the last segment, which I think should be the most interesting, will be the Q&A. And I want to invite Eugene Leong, the Deputy Director, Monetary Domestic Market Management of MAS, who will moderate the Q&A session. So please put in your questions, continue to put in your questions on the pigeonhole, okay?
Hello. Hi. Hi. Good morning, everybody. Thank you for joining us today. We have about 170 of you logging in from your various workplaces or from home, and it is a valuable opportunity that we have to reach out to you. So today, on the panel, we have a list of experts who will be addressing some of the questions that you may pose. In SG1, we have Matthew, the global head of rate structuring. For subgroup 2, we have Ki Pong, head of capital markets and global investment banking from OCBC. And in subgroup 3, we have Jonathan Phua, the group program director for IBOR Transition from DBS. On subgroup 4, we have Lawrence from UOB, the managing director and head of group business banking. On subgroup 5 legal, we have Chi Kin, the managing director and head of group legal compliance and secretariat from DBS. And in subgroup 7, we do have Mikael Larsen, group tax and accounting policy. And my name is Eugene from the Monetary Authority of Singapore. As well as on our panel, we have assistant managing director, Mr. Leong Seng Cheong from MES. I also have my colleague, Alvin Teo from MES, deputy director, who is joining us from an offsite location and dialing in, and he'll be also taking your questions because he's one of the active participants in some of our subgroups. So today, we do have a lot of questions that have come in so far, and I'll try to take this from a thematic perspective, going down the popular questions according to 3 categories. The first set of questions will be from technicalities, and then transition, and the last set would be more questions that you would be very concerned about from a customer perspective. So in technicalities, we'll go through issues such as fallbacks, new markets, how the new markets will function, and then an issue that's popping up very, very hotly, term SORA, and some of the issues around that. So maybe to kickstart, we will start off with a question for Matthew on term SORA. And this looks like the one that is most popular and on top of everybody's minds. It says development of term SORA was set previously by the end of second half 2020. Is the SC-STS publishing the basis in determining when is liquidity sufficient? Matthew, please.
Yeah. So I think the development of term rate is something that's in everybody's mind because it's a way of having new benchmarks that are going to behave very closely to the rates we are currently using. So I think a few things that we need to highlight. So first, to have a term SORA. So what would be a term SORA exactly? It would be, for example, for a 3-month period, the rate implied by the market to convert the SORA fixing every day over the next 3 months into a single rate, into a forward-looking rate. So that means that you have a rate that when it's fixing at the beginning of the period, you can use for your upcoming calculation period. For the market to be able to have term SORA, we need to have obviously an active swap market against SORA. So that's something the industry as a whole is working on developing. The use of term SORA, I think it's important to highlight it, is still being discussed, but important to keep in mind for everybody that the primary benchmark for derivatives in particular would be the use of daily compounded SORA. So I think there have been a lot of discussions in other markets as well about the use of term rates, and the trend that we can observe from markets like UK or Switzerland is that the use of term rate is actually limited to very, very specific situation. And the trend again is more to head towards compounded, the use of compounded rate.
Yep. Thank you. And I would, going on this same topic about term SORA, I would want to invite Jonathan to also share some perspective about some of the plans on using some of the exploration of some of the product structures and various measures and the thinking on using about compounded rates and etc. Jonathan?
Thanks, Eugene. So when it comes to term SORA usage, there are a number of ideas that subgroup 3 for loans is exploring with subgroup 1 for derivatives. So, for example, that includes having a compounded SORA loan and then hedging that out with an interest rate swap so that the borrower winds up paying a rate that is very similar to the SOR rate today in terms of its in advance fixing. So there are a number of different alternatives that we are exploring together with early adopters in the absence of term SORA rates published on Bloomberg. And we will continue to look into this in the months ahead.
Thank you, Jonathan. So switching on, going still on the issue of term SORA. Wait, give me a minute. The questions are jumping. Okay. Going to Matthew again. Will the forward term SORA be based off SORA OIS? Will there be plans to develop a futures market for SORA? Maybe I may invite Matthew to jump in on this first, and then I'll see if Alvin has anything to add on.
So I think, yeah, it's important to keep in mind that SORA will become the new benchmark for derivatives, and as such, it will, just like any other interest rate benchmark, it will have a full-fledged market, and that means that in practice, you will be able to have a forward or a term structure of SORA based on the swap market. I think unlike what we are used to currently with SOR, which is a rate that typically fixes on a semi-annual basis, we are moving towards a rate that's fixing on a daily basis. So it probably means that the swap market will start from probably as short as a week or a month and then extend all the way to several years as the market picks up.
Thank you. Alvin, would you like to add on anything?
Yeah, I'll just add on. I see the second part of this question concerns whether there will be plans to develop a futures market for SORA. I think the committee is not close to this development. However, it must be said that the Sing derivatives market has traditionally been an OTC market, and this is where efforts are starting as users' familiarity and infrastructure for this is in place. It can be determined subsequently if there's sufficient interest and volumes in the market to sustain both an OTC and exchange-based market. But for now, I think the efforts are definitely in the OTC space, and if a term SORA benchmark were to be constructed, it's likely to be based off OTC SORA OIS markets.
Thank you, Alvin. So sticking on this topic of term SORA and moving to perhaps the last question on term SORA, there's a question of, in view of uncertainty of whether banks will adopt compounded SORA or there will be a term SORA, is it feasible at this stage to start investing in systems enhancements? And maybe I would invite Matthew to jump in first before Jonathan takes a look at it from the loans perspective.
Yeah, so I think the system aspect of things is the point that's been highlighted during the presentation this morning. The timeline for the transition is actually quite short, and it very likely involves changes in systems, operations, accounting that needs to be worked on as early as possible. I think that's one very important point we should remind everyone of. In terms of getting your systems ready, again, I think it's good to start. And ultimately, term SORA would behave in a fairly similar manner to what SOR or LIBOR are behaving today. So again, I'm assuming it would not require significant changes in system. So I think the question is more, do we need to be ready, or do end user need to be ready for compounded SORA? And my view on that would be that I think it's a better thing to do, because whether it's for Singapore or for other markets, there is an industry trend towards compounded rates. So I think it is important indeed to have systems that can tailor for, I would say, the traditional forward-looking rate as well as the new trend, which is compounded rates.
Thank you. Jonathan, you want to add on some?
I think it's particularly important to invest in systems enhancements to be ready for compounded rates. As Matthew alluded to, although you might have sufficient swap liquidity in one market to produce a term rate, you are not guaranteed that for all the different currencies and all the different benchmarks that are emerging, such as SOFR, SONIA, and in the Swiss market, they've already said there will not be a term rate. So because of that, it's important to start investing in system enhancements early.
Thank you, Jonathan. Moving away from term SORA, the next set of questions around it relates to fallbacks and adjusted SOR, which is quite interesting. And maybe let me just go to this question. Would there be an interim adjusted SOR swap market? And maybe may I invite Matthew to on this, and maybe Alvin, if you want to supplement anything later, please feel free to jump in as well.
Okay, so I think that's an important point to understand. So adjusted SOR is there essentially to ensure that there is a full set of fallbacks during this transition. So one of the key challenges the industry overall is facing with this transition is that some contracts are currently not robust enough to cater for a permanent discontinuation of the rate. And that's why basically we need to ensure we have rates in place that can basically be used as a final fallback. So that is in essence the objective of adjusted SOR, which is to be a final fallback for contracts that have not been transferred yet to the new benchmark. So a point that we've mentioned earlier in the presentation that we should re-emphasize is that it is very important to reduce as much as possible the stock of existing SOR-based transaction and increase the stock of SORA-based transaction and leave adjusted SOR ideally to a small portion of the overall transaction. Conclusion of that, to answer that question, is that no, there will not be, it's very unlikely there will be any adjusted SOR market. The market will simply move towards SORA. That's the objective.
Thank you. Alvin, you want to add anything on to this?
No, I think that's a very comprehensive answer. Thank you.
Thank you. Okay, and I suppose this also answers the question about the measures being considered to avoid overuse of adjusted SOR and derivatives, and whether there are any guidelines on this. As Matthew said, we do not expect there to be an adjusted SOR swap market. So moving on to adjusted SOR in loan markets, and a question for Jonathan. Is that since adjusted SOR is only known at the end because of the compounded in arrears method, how does that work for SOR-based loans?
So since it is known at the end, it is a large change for loan markets, in particular with regard to systems readiness. It's very similar to the transition between SOR and compounded SORA, where it would be a rate that is known at the end of the period. So that is what the fallback to adjusted SOR will mean for loan markets.
Thank you. Okay, I'm going back to Matthew. Many of the questions around adjusted SOR. If I have an IRS that matures after the cutover and fallback to adjusted SOR kicks in, does it mean that the fixed amount I'm paying under the swap may change after the replacement rate takes effect?
Okay, so all right, so it could be, I guess, an IRS or any swap that's maturing after the expected discontinuation date. So what's happening in practice is when you have a swap, you have a fixed leg and you have a floating leg typically. That floating leg refers to an index defined in ISDA. And if that index were to disappear or be discontinued, then you need to follow the fallback mechanism that's included in the ISDA definition. That is why ISDA definitions are being amended in the case of SOR, to include adjusted SOR. So that's something that will be published, I think, in the next few months. So what does it mean? It means that the adjustment typically is going to happen on the floating index. So basically, your existing floating index, which is SGD SOR VWAP, will be having a fallback that goes to adjusted SOR, and that is this component that will be adjusted. And to reiterate, I think, for clarity's sake, this adjusted SOR will be working in the same lines as what SOR is currently currently computed. The only thing is the US dollar rates component will be moving from LIBOR to adjusted SOFR plus a spread. So that's this dollar rates component that changes, and that's ultimately the only component that will change in your swaps.
Thank you very much. I'm going to the legal aspect and the ISDA documentation on this, and if I may invite Chee Kin to step in on this. The question here is that, is there a final ISDA legal documentation setting out the new fallback adjusted SOR, which is ready and can be used by market industry players now?
Thanks very much. So there is a final version of the definitions, but it's not public yet. As briefed earlier, it is intended that ISDA will make this publication really towards the end of the first half or the early second half of 2020. It is therefore not advisable to move now ahead of the ISDA protocol, which is actually the whole industry moving together. If you move now, then there's all kinds of things, whether your counterparty will agree and so on and so forth, that could complicate issues. So the derivatives practitioners know that there's a definition that's ready. It's not public yet, and let's all move together with the protocol. Thank you.
Thank you very much, Chee Kin. Going to new markets right now, the team. And maybe I may invite Matthew again on the approach for cross-currency swaps. The question here is, what is the approach for CCS, since there will be two reference rates available? May I invite Matthew to jump in on this, and if Alvin, you have anything to add, please add on as well.
Okay, so for cross-currency swap, again, like today we see the market as quoting US dollar LIBOR against Sing SOR plus a spread or minus a spread, depending on the direction. In the new world, these swaps will typically be quoted against SORA. SIBOR is not intended to become an underlying for the derivatives market. So I'm not saying there will never be any swap on SIBOR, but SORA is meant to become the principal benchmark for interest rate derivatives. What's important to understand is that we are moving from SOR, which is an FX implied index, and that means there is inherently inside SOR a liquidity component, a dollar liquidity component that is not there in SORA. So in all likelihood, the cross-currency swap basis will actually look a bit different compared to what it looks today, and it will look more similar to what we see in markets like yen, euro, sterling, where you have an actual premium to borrow dollar against a local currency.
Thank you. Alvin, do you have anything to add on this?
Yeah, I agree completely with Matthew's answer. I just want to add that to facilitate the market's take-up of such contracts such as CCS, OIS, and other SORA derivatives, the subgroup 1 will be putting out templates for these various types of derivatives contracts, and this will be available on the new SOR to SORA ABS website relatively soon.
Thank you very much. And moving on, maybe a bond market question right now for Kee Pong. And it goes on to say, what are the advantages, disadvantages of adopting look-back versus lockout observation period for SORA?
Thanks, Eugene. I would see it more as differences rather than advantages versus disadvantages. I think it's whether you would be comfortable with the observation period vis-a-vis the interest calculation period. And in whether in look back or lockout, there is a period whereby you would fix the rate. So in a look back, you basically shift the calculation period back by 2 days. And therefore, in a way, there is a 2-day uncertainty which you need to be comfortable with. If you think about it, it's not too different from an FRN fixing, where you fix the rate 2 days before the interest period starts. So you still need to think about that 2 days of change, right? That could happen after you fix the rate. So from that perspective, there is not much different between when we move to SORA and kind of what we are seeing now for a SOR-based FRN floating rate fixing, for example. Look back and lockout, the other difference would be that for lockout, the final fixing would be just 2 days before the interest period, and the calculation period starts at the same time. Whereas in a look back, the difference between the interest period, observation period, and calculation period is shifted by 2 days back.
Thank you very much, Kipong. Okay, switching gears to the loans and corporations, and one of the top questions right now, and may I invite Jonathan to take on these questions. How do you suggest corporations to make cash flow forecasting on loan interest expenses with interest rate being known only at the end of the period? Will there be guidelines from the committee?
Yes, so this has been an area which has had quite a lot of discussion in the loan subgroup. The short answer is that loan conventions using compounded SORA are likely to have a similar type of look back that Kipong just mentioned. So a look back of a certain number of days to allow the interest to be computed before settlement. Now, if you are talking about something like the customer wanting a rate even further in advance, like say 1 month or 2 months, then one thing that has been considered is calculating an indicative rate based on the compounded rate as of, let's say, 1 month before settlement. And then at the point of settlement, you have an adjustment that is made. That could also be done. It's important to note, as has been previously covered in the presentations, that compounded in arrears SORA is going to be an averaged rate. And so therefore, it will be likely less volatile. And so if you take a look at some of the charts that Matthew was presenting, it is a comfortably smoother line than the jagged line that is historical SOR fixings. And so we expect that the size of that difference between an indicative and the final rate used for settlement will be quite small.
Thank you. Since following on this train of thought, I mean, the next question is also about charts. From the chart, for Jonathan, it looks like a SORA PEC loan will be cheaper than a SOR PEC loan, and in brackets it says assuming the same margin. Is this true, Jonathan?
I'm afraid we can't say that because the two rates are driven by very different underlying economic drivers. So you can't say that one will always be lower than the other. If you take a look at the charts that the historical charts going back to 2005 that Matthew had covered, there were 2 periods in which compounded in arrears SORA was actually higher than SOR. One is the point at which SOR went negative, and the other is around the middle of 2005. But recent trends have suggested that it will be a lower rate than SOR.
Thank you, Jonathan. So going on, switching back a bit to the derivative space, for a question for Matthew, the GPP market as of now seems to be seeing most of the OIS trades concentrated to less than 2 years, and most of the greater than 2 years trades are still LIBOR based. if SORA ends up the same stage, then how should we proceed? Maybe Matthew, you can take a step, and Alvin, if you have anything to supplement, please jump in as well after that.
Okay, so I think it's a good approach to look at the sterling market, because I think it's a few months ahead of the Singapore market in terms of market evolution. Actually, I think the SONIA market currently is one of the biggest derivative market based on the new benchmarks. I think the derivative market is actually even bigger than for US dollar, which is in essence a much larger market normally. So that I think that's a testimony of the speed at which the sterling market has moved towards SONIA. I've personally not observed this split between short-dated and long-dated trades. I think there are still sterling LIBOR exposures that require sterling LIBOR swap, but the latest data I've seen actually suggests that currently the market is at 50% based on SONIA, 50% based on LIBOR. It's pretty natural that short-dated trades tend to have larger volumes, so that's probably why we see more sub-2-year trades. So for SORA, the challenge will be to ensure we develop a deep and liquid market quickly. And I think unlike some new benchmarks, it will basically start from close to zero. So it's very important that the industry is able to quickly offer markets based on SORA. It is very possible that there will be a higher liquidity in the short end, but that the liquidity will slowly develop across the term structure as we have moving forward.
Thank you very much. Alvin, do you have some perspective to share as well?
Yeah, sure. I think liquidity will follow where there is demand, and we should not prejudge outcomes. One thing to note is that as the cash market take-up of the risk-free rates increases, then there will be that need for that longer tenors derivatives to hedge the cash market exposures, and there you will see this increase in volumes, definitely first in the SONIA market, but I presume also in the SORA market subsequently.
Thank you very much.
Just one quick point to add. So it was also mentioned this morning that there are discussions to have SORA-based derivative on clearing, and that's typically facilitating the development of a longer-dated derivatives market.
Thank you. Thank you. Switching back to loan markets for Jonathan, a question for Jonathan. I think this question is asking about the compounded setting in advance versus compounded setting in arrears. So to address concerns of not knowing the interest rate until end of the period, will banks industry consider using historical SORA plus spread, e.g. the 3-month historical daily compounded SORA plus spread to be used for 3-month interest rate payment? Jonathan?
I think so. All the banks in the loan subgroup, which includes the local banks, foreign banks operating in Singapore as well, have discussed a range of different options, a menu of choices that will continue to be offered to clients even after SOR to SORA transition occurs. So this using what is called a compounded in advance rate is one of those different options, including things that the market is more familiar with. You know, we are familiar with fixed rate, we are familiar with cost of funds. So it's one of a number of options that is being considered, but these options have different degrees of cost efficiency and different rates at different points in time.
Thank you very much, Jonathan. And going on back to the derivatives market and about the SORA OIS trades, and I'll invite Matthew and Alvin to jump into this. Could committee members share more details of their SORA OIS trades widely? It would be useful if we can see prices, codes for SORA OIS on screens.
Sure. So I think the recent trades were advertised, I think via press a little bit. The important thing also is that we are setting up standards for how the fixing and how the template basically for swap should be determined. So I think that's very important. In terms of being able to display prices and quotes of SORA-linked derivatives, that's something we'll certainly see coming up shortly as the market liquidity develops. And I think that's clearly one of the key agenda for this year for the working group.
Thank you very much. And I think, Elvin, would you like to add on anything on the screen?
Yeah, absolutely. So I do think it is important to have increased visibility on the SORA derivatives transactions that are being undertaken. I mean, right now it's quite hard to find the information. Some of the banks that have undertaken these transactions have put it out on their press releases, but it's relatively sparse. We need to improve information access. And I mean, one of the things is that traditionally you could go, for example, to your Bloomberg screen and dig up the SCR function and look for the DTCC transactions for your IRS transactions. Something like this should be worked out for the SORA derivatives transactions as well, because these transactions are also subject to reporting requirements. So that information will be available. Besides that, I think the committee also will probably be looking into putting out periodic updates on aggregate developments in the market, just to keep people apprised on how this market development is progressing.
Thank you, Alvin. Okay, so I think we have covered most of the questions on the technicalities team. Moving on to something about the transition before we go on to some of the customer-centric and customer angle questions. On transition, there's this for Mikhail, there's this question on tax. It says the US IRS issued proposed regulations to help taxpayers avoid negative tax consequences in the transition away from LIBOR. Will there be an equivalent exemption from IRAS for SOR transition?
Yeah, as I mentioned in my presentations, we are looking to engage IRS on these points, but it's a bit too early to do that right now. I'm aware of the US proposed regulation, and although it's beneficial in most cases to taxpayers because it gives some relief, the situations in which this relief is given is also quite restrictive. And as I mentioned in my presentation, if you avoid derecognition, which is this point about taking some of your loans off your books and then back on, it seems to me that you would avoid most of this P&L volatility on the loan side, and therefore you wouldn't have many tax consequences as a result of it. And that seems to be the requirement that matches the US IRS situation. So until we have a better sense for what could be some of the P&L events, I think it's too early to address it with the IRS.
Thank you very much. Going on to a question about for loan markets, is it feasible for Jonathan to transition all SOR loans transactions before fallbacks are triggered? Why not allow 5 years transition period for legacy loans? Yeah, may I invite Jonathan and maybe Elvin to jump in on this issue?
So we think the loan subgroup thinks that transitioning of SOR loans before fallbacks are triggered is likely to be preferable because of the extent of bespoke negotiations that is likely to happen if you rely on fallbacks to be triggered at the point of SOR discontinuing publication. So we think it is better to avoid that risk. Having said that, the loan subgroup will be coming out with recommended enhanced fallback clauses in case there are certain subset of loans that require this safety net. And we think that it is better that this be kept as a safety net rather than something that we actually test and try to use.
Thank you very much, Jonathan. I think the other angle that came out in previous discussions was about the matter of shelf life for the fallbacks for adjusted SOR. And may I invite Sing Chong to share some of the perspectives around this issue?
Thanks, Eugene. I think from
and all SOR contracts have to be transitioned out. What the steering committee hopes to do is, based on the regulatory survey that will be sent out, we need to get a sort of firmer feel and grip on how, to what extent the industry will be able to transition out by a certain point in time. And then we will also need to study the profile of what is the expected amount and volume of legacy loans that will continue to be outstanding past 2021. And then based on all this data, we decide what type of cutoff is reasonable, particularly for adjusted SOR. In essence, steering committee will have to balance between two key considerations. The first is obviously the longer transition period you provide for legacy loans, the more comfortable it is. However, it does leave us with a very fragmented landscape, which is not very optimal from the perspective of market development, building liquidity in SORA markets, and is also not cost efficient for FIs. So I think that the main guiding consideration for steering committee will be the earlier we can complete the full transition of SOR loans, the more efficient markets will be.
Thank you, Seng Chong. Switching to for Matthew, the question here says asks, what are the likely impacts that fund managers should prioritize getting ready for the change to SORA? What are some of the impact and what are the preparation that they need to do to get themselves ready for transition?
Okay, so I think that's quite a broad question. So we've mentioned the operational aspect. So I think that's probably the first thing they should be looking at. What's very important is two things, right? Is assess what is the amount of the current exposure, and typically that means looking at the stock of bonds, loans that the fund manager may have invested in. Are there any derivatives that are matching these underlyings? And are the fallback mechanisms between the underlying and the derivatives aligned? So I think that's the initial thing that's required is basically assess the amount of exposure and how it can be addressed. And looking forward, it will be a mix of getting ready to trade SORA from an operational perspective, as well as from an instrument perspective. So I think fund manager, and if we extend that to typically insurance companies, are often looking to do long-dated swaps to hedge their dollar assets back into Sing dollar. So they need to assess the liquidity and the cost impact of the new markets based on SORA. So I think that's basically getting familiar with the market, getting the systems in place, understanding the templates, and so on, to have everything in place to be able to deal SORA-based derivatives.
Thank you very much, Matthew. Turning to a question on compliance in terms of in respect of the transition, and I'll direct this question to Chikin. Is there any direct impact on functions such as compliance with respect to this transition? Are there any controls or monitoring measures that need to be put in place?
So I would say we welcome questions such as this, which kind of would cause us to also put some effort into giving guidance on specific personas or functions that should need to think about second order impact of the transition. In general, I think what we should expect that there would probably be some level of incremental controls in relation to SORA products, right? So for example, surveillance of SORA products, for example, communications of traders involved in SORA, for example, the data flows into surveillance systems in order to accommodate SORA transactions. So there should be incremental effort of incorporating SORA products into your current controls framework. I would also add that we should also think about decommissioning controls that are relevant to products that are going to be decommissioned. So clearly, we currently have an array of effort also attached to SOR transactions, and that effort clearly should be reviewed, and at the appropriate time, we should decommission that effort as well. Okay, I think what we'll do, given that this is a question that has come up, we will also put some effort into giving some FAQ guidance on what people should be thinking about for the compliance function.
Thank you very much, Chee Kin. Switching gears, and a question for Seng Chong. Will MES or the steering committee recommend or implement a deadline to stop new SOR transactions? Seng Chong, please.
So the answer is yes. This is very much on the agenda of the steering committee. It's an important issue because, we want to make sure that at some point, the industry doesn't generate new SOR-based loans that only serves to add to the outstanding legacy stock. So the steering committee will have to, as I mentioned earlier, based on the survey returns, look at the data, have a feel of how the industry is going to transition and by what time period. And then the steering committee will make a considered decision when the cessation date should be and when to announce the cessation date. In my earlier slides, we do indicate that the steering committee will try to make this decision by the end of this year.
Thank you very much, Seng Chong. We move to the last set of questions about, and it's somewhat related to transition. It's on the customer angle type of matters that are very close to your heart. And this is directed to Chee Kin. Who is going to bear the charges for repapering, especially if lawyers, and the lawyers is with a capital L, have to be involved?
Yeah, I know this perception that lawyers with a capital L are mercenaries. Yeah. So I'll take a little bit of a step back, and I think you've heard what SG5 is putting a lot of effort into, right? Which is to cushion the impact of repapering. It's probably not in the interests of the industry in a transitional scenario, which is actually not our fault, right? It's because of the cessation of dollar LIBOR that we are having to put in this effort. If it's not our fault, it doesn't make sense that there's a whole lot of, in a sense, incremental effort across the industry. So we're going to put a lot of work into trying to cushion the impact. Now, if I may simplify the issue slightly, and this is now at risk of overgeneralization, expect that there will be a proposal that will come out. Okay, so that proposal could be in the form of an ISDA protocol. It could be in the form of an offer by the banks. It could be in the form of, a proposal in some other type of form. But the proposal will come out. And so that will be contractually an offer. All the legal spend up to that point of time assume that the counterparty to that offer won't have to incur much cost, right? Because that clearly is the effort that's expended either by the industry or by the person who's kind of like making the offer. Now then, at that point in time, the counterparty can decide what they want to do, right? So if the counterparty then chooses to accept the offer, then of course there's no incremental legal spend. If the counterparty, however, chooses to negotiate that offer or to kind of like raise other related issues, and then that counterparty chooses to engage a lawyer in order to carry out those instructions, then that becomes at the cost of the counterparty who chose to engage that lawyer. Now, this is a generalization, but I hope that it gives us a way of thinking about how the spend will go. Always bearing in mind SG5 is going to do a lot of work to try to cushion the impact to the industry.
Thank you very much, Chee Kin, for this very comprehensive answer. And I think it kind of addresses a few points here on charges and in terms of protocols as well for conversion. The other set of questions that I think this question is alluding to, and that we have gotten so far as well from various feedback, is really about the questions of whether how will I be impacted in terms of costs for this transition when we switch a benchmark rate. Am I better off or am I worse off? And if I may take this opportunity to invite the various speakers to share their perspective on from their various product classes. Maybe starting with Matthew first, and then Kipong, and given today's crowd, Jonathan, and then maybe Chikin, you want to add on some things, and before maybe Seng Chong shares the perspective at the broader level from the steering com. Maybe we start with Matthew, please.
Yeah, sure. So of course that's a very important aspect, and it's important to I think remind everyone again that this transition is happening globally, so in all key markets, with the objective of making market more robust and more transparent. So I think that's important to remind everyone of the intention behind this transition. Looking at the derivative space, so I think two aspects again. One is going to be on your legacy contracts, and something we've mentioned in the presentation is the risk for potential valuation jump. So what is the valuation jump? Is basically if you have a derivative asset or derivative liability upon the transition, since we are amending the floating rate index in your swap, there is a chance that the value of that derivative asset or that derivative liability will jump. So it can be a positive jump or it can be a negative jump depending on which direction you are going to be in. But that is one of the potential cost impact or P&L impact that you will be subject to. And again, it could be a positive move, it could be a negative move. And again, to reiterate, the best way to avoid any surprise, so you may be willing to have a positive surprise, but you may want to avoid a negative surprise. The best way to do that is to slowly but surely transit towards SORA ahead of the transaction to avoid this kind of digital jump.
Thank you, Matthew. And maybe Kipong from the bond market space.
Yeah, I think certainly when we make the transition, and as what Matthew and all my other member colleagues have mentioned, that in the longer term, I think the market would appreciate this because one, it's a risk-free rate. Two, it smoothens out at least from a currency per se perspective without the FX associated FX volatility that IBOR-based currencies have experienced in the past. But suddenly, at the switchover period, there could be an adjustment that's required. But once the adjustment is kind of fully absorbed, then going forward, we do expect that the markets would be more transparent and efficient, and therefore, everybody would be benefiting from it. Right. From a bond market perspective, at least if I look at it from a $1 bond space, they tend to be predominantly fixed rate, right, because of the demand supply. However, that's not to say that floating rate instruments cannot be made available. So to some extent that there is this demand and supply along that front, that at least we can prepare, for that eventuality. And if we are moving towards risk-free environment, that's probably a good way to think about how we determine rates and think about them even on a relative value basis by breaking down a rate which you borrow at in terms of the risk-free rate plus the term spread or premium or discount and the credit spread, right? So the building blocks are clearer. In a way, without FX effects, and something that I would think markets would be more receptive to. And certainly, we are not alone in this. And the whole global, everybody is being touched upon with this transition. And so the more aligned and the more in tune we are with one another, I think that definitely helps and benefits everyone.
Thank you. Jonathan?
Thanks, Eugene. Kipong touched on a couple of points about the rate, the stability of the rate and the transparency of the rate. So I'm not really going to go into that, although that also applies to the loan market space. Instead, just taking a bit of a step back, I think what we have tried to communicate today is that before SORC's publication, there is a menu of rate options that is available to all corporate borrowers. And in the future, going forward, that will still be the case. How some of these rate choices are computed is changing. but the economics of the loan market are not changing. We are still your banks. We would still prefer to have more of your business rather than the less. And you will still be able to comparison shop between banks, and banks will compete to give you the best choices that best fits your needs. So that's that will continue to happen going forward.
Thanks, Jonathan. Maybe I'll jump over to Jikin if you have anything you want to jump in.
Yeah, maybe I'll take a little bit of a step back, right? This is not the first time we've transitioned benchmarks. So actually 2012, we had to transition benchmarks as well in terms of NDF, SORS. I would say that actually, as an industry, there is a degree of experience and track record around transition. And I would reflect that actually the transition experience, knock on wood, has been relatively stable, and long may that continue. We'll put in the work necessary to try to make sure that this is as smooth as possible.
Thank you, Jikin. And switching to Seng Cheong, for sharing from the SC's perspective.
So, from the steering committee's viewpoint, the most important priority for us is actually to take a customer lens. It is important from the customer's point of view that industry puts in effort to educate the customer, work out the implications for the customer, and enable the customer to make an informed choice. So, there are lots of, technical perspectives that was shared this morning. But in gist, right, all the work that the steering committee is doing is playing to that, right, which is maintaining a customer-centric approach. It involves getting the SORA markets up and running, making sure prices are visible, customers can see them. It involves developing standard, consistent, transparent protocols, right? Helping customers to transition out of SOR, right? And also, encouraging take-up of new SORA products. The most important thing is there is standard consistency, right? And that customers don't get confused between different practices, right? So essentially, all the work that we're trying to do is aimed at promoting openness, transparency, putting information out there, and making sure that customers are able to make informed choices.
Thank you very much, Seng Cheong. And with that, we've come to the end of today's Q&A session. And I'll pass the time back to Mr. Song.